The next topic we need to cover is how to handle a change in estimate. Change in estimate is handled prospectively. Overall, this is going to be much easier to adjust for compared to a retrospective adjustment, since we don't need to go back and change anything. In this example, we'll be dealing with a change in depreciation method. Remember, a change in depreciation method is really just a change in estimate, because depreciation methods are just estimates of when the future benefits of an asset will occur. So whether we change depreciation methods or we change an estimate within a single depreciation method, we'll handle this in a similar manner. All right, so to see how we do this, let's use an example. On January 1st, 2013, Quicksilver purchased equipment costing $50,000. It's depreciated over 5 years, assuming a $5,000 salvage value and the sum of years digits method. On January 1st, 2015, Quicksilver switches to the straight line method of depreciation. So when we have a change in depreciation method, the first step is going to be to determine the book value. Right, and we'll determine book value as of the date of change in the estimate or depreciation method. If you recall, book value is just the cost of the item minus the accumulated depreciation. So in this example, we're not given the accumulated depreciation as of 2015, so we need to go back and calculate depreciation for 2013 and for 2014. In this example, we're using the sum of years digits method. So if you recall sum of years digits, we take cost minus salvage, and we'll multiply that by the depreciation rate. Depreciation rate in this case, in the numerator, we have the remaining useful life. And in the denominator, you use the sum of years digits. Okay, so in this example, the useful life is told to be 5 years. So for 2013, we'll just apply this. We'll just apply this formula here to this example. So the cost here is $50,000, and the salvage value is $5,000. 2013 is the first year the company purchased this, so since it has a 5-year useful life, we still have 5 years remaining of useful life. And then the sum of years digits, since the useful life is 5, the sum of the digits would be 5 plus 4 plus 3 plus 2 plus 1. Okay, so if we just do some algebraic manipulations here, get up to 45,000 times 5, and in the denominator we would have 15. Right, so we'd get up to $15,000 of depreciation. In 2014, we could follow a similar process. Again, cost minus salvage will stay the same, so we're taking 45,000, and now we're multiplying by the remaining useful life. Since 1 year has passed, we have 4 years remaining life left. The sum of years digits stays the same. If we multiply that through, we would get out to $12,000. Right, so as of 2015 then, the beginning of the year, we have accumulated depreciation of $15,000 from 2013 plus the $12,000 in 2014. So altogether, we're at $27,000. So that tells us then our book value is our $50,000 cost minus the accumulated depreciation of $27,000, which gets us out to $23,000. So step 2 then, after we figured out the book value, is we're going to use this book value as the new cost basis. Okay, so to see what I mean by that, in 2015, we're switching to the straight line method of depreciation. So under the straight line method, our depreciable base will again be cost minus salvage. And again, we can multiply that by a depreciation rate. Right, for straight line, depreciation rate is 1 over the useful life. However, in this case, since we are making a change in the depreciation method, the denominator will be the remaining useful life. All right, so so cost minus salvage here. Again, we said we use the book value as the new cost basis. So I'm going to replace the cost here with the book value. Right, so from here, we have our formula for determining depreciation expense in the year of the change. So our book value, as we just determined, is $23,000. Our salvage value, we're still going to use the $5,000 since we haven't changed that. And then again, the depreciation rate is 1 divided by the remaining useful life. Again, the total useful life is 5 years, but 2013 and 2014 have passed. So we have 5 minus 2 years remaining. So 3 years in total. Right, so if we multiply this out, right, we end up with 18,000 over 3 years. So we end up with depreciation expense of $6,000 per year. So then in 2015, we would recognize a total of $6,000 of depreciation expense. So you would debit depreciation expense for $6,000, and you would credit accumulated depreciation, as you already know. So this next slide just covers what we just went over. So the last example went over a change in depreciation method. If instead of changing a depreciation method, a company still uses the same method, but they change an estimate within that method, like the useful life or the salvage value, we're going to follow the same exact process. All right, so I'm going to get rid of this. Right, and we have our 2 steps up top. Okay, so in this example, it tells us on January 1st, 2013, Quicksilver purchased equipment costing $50,000. It's depreciated over 5 years, assuming a $5,000 salvage value and the straight line method. On January 1st, 2015, Quicksilver estimates that the equipment will have a remaining life of 8 years with a $0 salvage value. And so it's asking for the amount of depreciation expense in 2015. So again, step 1, we're going to figure out the book value, and so we need to figure out accumulated depreciation for the first 2 years. In this example, we're just using straight line all the way through. So again, under straight line, take cost minus salvage, and we can divide that by the useful life. So in this example then, cost is $50,000, salvage is $5,000. We'll subtract those 2. And we'll divide all of that by the useful life of 5 years. So we will get out to $45,000 over 5 years, or $9,000 per year. Since 2015, we would have 2 years of total depreciation, and we're using straight line or accumulated depreciation, which would be the $9,000 per year times 2 years, which gets us to $18,000. So that tells us our book value is the cost of $50,000 minus the $18,000 in accumulated depreciation for 32. Right. Step 2, we'll use the this book value as our new cost basis. So again, we largely have the same thing. We have cost minus salvage divided by our remaining useful life. So we're using the book value as the new cost basis. So cost here will be $32,000. We've changed the salvage value on 2015 to a 0 salvage value. So we're subtracting 0 from that. And then in this example, it tells us we estimate that the equipment has a remaining life of 8 years. So we divide by 8. So in this case then, $32,000 divided by 8 is $4,000 per year. So in 2015, we would recognize $4,000 of depreciation. The last example of a prospective change we'll go over is when a company switches from FIFO to LIFO. Again, even though the company is switching its accounting method here, when a company switches to LIFO, generally it's impractical to go back and figure out all the different inventory layers in the previous years. So we'll just handle this prospectively. So to see how we do this, let's just take a look at this example. So Quicksilver changed its inventory costing method from FIFO to LIFO on January 1st, 2015. The company uses a periodic inventory system, and based on FIFO, its December 31st, 2014 inventory consists of 100 units at $12 per unit. During 2015, Quicksilver made the following purchases of inventory, so as shown here. And then during 2015, Quicksilver sold 390 units for $11,700. So what is their cost of goods sold in ending inventory in 2015? Okay, so we're switching from FIFO to LIFO, and since we don't handle this prospectively, all we're going to do is apply LIFO to this situation. So as we saw earlier, your costing methods or inventory cost flow assumptions just influence your cost of goods sold calculation, which then affects what the amount we report as ending inventory, and that goes on to affect our net income. So to incorporate this change, we'll again start with the formula for accounting for inventory. So you start with the beginning amount, you'll add your purchases. That'll get you out to your goods available for sale. And then from there, if we subtract out our cost of goods sold, we'll end up with our ending inventory. Okay, so our beginning inventory would be our beginning inventory under FIFO, because again, we're handling this prospectively. We're not going to go back and change anything. We'll just use this new method in the current period going forward. So in this example, it told us based on FIFO, our ending inventory in 2014 consists of 100 units at $1,200 per unit. So that tells us our beginning inventory would be the $1,200 here. Okay, so that's just the 100 units times 12 apiece. Right, and then in this example, we're given all these purchases in this table here, and the total cost of these purchases was $7,500. Okay, so if we add our beginning inventory to our purchases, we end up with $8,700 of goods available for sale. All right, so since we're switching to LIFO here, under LIFO, it's last in, first out. So we're just going to apply LIFO to determine cost of goods sold here. So in this example, we sold 390 units. So we just need to determine of our goods available for sale, which of the 390 units of these is considered to be sold or assumed to be sold. Since it's last in, first out, we'll begin with the very last date, December 30th, 2015. Right, we would assume we sold these units first. So on this date, we had 100 units. I'm just going to create a table here to make this easier to see. So units and our cost. And then our total cost. All right, so we assume we sold these 100 units first. They have a cost of $17 a piece. So that gets us out to $1,700. All right, we still have to count for another 290 units sold. So we'll go to the next date, October 4th. Again, it's 100 units on that date. The cost was $16. And that'll bring us out to $1,600. Right, so now we've accounted for 200 units sold. We still need to go to the next date, August 31st. On this date, we purchased 100 units. They're at 15 apiece. So now we need to account for the next 90 units sold. And that date, next date would be the May 18th. Right. On this date, we purchased 100 units, but we only need to account for 90 units sold from this date. So our cost here is 14. Right, so in total then, if we sum up these units and the cost, right, so these 390 units we sold, the cost was $60.60. Right, so now we know our cost of goods sold is $60.60. We can plug this in back up here. Right, and once we've determined our cost of goods sold, we can figure out ending inventory. It's just the difference between our goods available for sale and our cost of goods sold for $26.40. Right, so in 2015, ending inventory is $26.40, and our cost of goods sold we determined to be $6,060. Right, so as you can see, for a prospective adjustment for a change in principal, this is much more straightforward and easier to do. And then the last slide is just corrections of error. As I mentioned before, for a correction of error, it requires a retrospective adjustment. So the company needs to figure out what accounts were affected by the error, and they need to go back and restate those. Again, since the temporary accounts would have been closed out into retained earnings, the company will also have to go back and report an adjustment to its retained earnings for prior errors. Again, as I mentioned, we're not going to go into detail on this, so you just need to know you go back for errors, you make a retrospective adjustment, so you restate prior year's financial statements, and then you provide a corrected retained earnings statement.